Hey traders, welcome back to Trader DNA, your ultimate destination for mastering the markets. Let's be real, technical analysis can be tough. If you're not crystal clear on what you're looking at, and if you're not analysing the right factors, you won't last long in this game. But here's the good news, I've got you covered. Today, I'm breaking down a simple yet powerful technical analysis process that will help you trade smarter, faster, and with more confidence. No more second guessing your entries, no more confusion, just clear, disciplined decision making that leads to better accuracy and bigger profits. Trust me, this is the kind of insight that completely transforms the way you trade. Instead of feeling lost and unsure, you'll gain the confidence to execute trades with precision, sticking to your rules, staying disciplined, and most importantly, maximizing your profitability. So hit that like button, subscribe, and stick around, because if you miss even one of these trading rules, it could cost you an accuracy and profit. Let's dive in and unlock this powerful trading strategy right now. One of the most powerful high probability entry signals, one that holds massive profit potential, is the trend reversal. A valid trend reversal shouldn't be hard to spot if you know exactly what to look for. In fact, it's right there in plain sight. And if you can capitalize on these shifts in trend direction, you can maximize your profits like never before. But here's the crazy part. So many traders, especially beginners and amateurs, completely fail to take advantage of trend reversals. Instead of riding the wave to bigger gains, they keep making the same mistakes, ending up with loss after loss. Meanwhile, those who truly understand trend reversals are cashing in on huge opportunities. So what's the big problem? Why is there so much confusion? And even more importantly, why does this same mistake happen over and over again to new traders? The truth is, most beginner traders overcomplicate trend reversals way more than they need to. And that's exactly what we're going to fix right now. In this video, I'll break everything down for you, step by step, so you can finally avoid the trap of overanalyzing trend reversals and start using them to your advantage. First things first, let's simplify trend reversals and bring everything back to the fundamentals. Too many traders get caught up in unnecessary details. Forget the noise. Focus on what really matters, making money, maximizing profits, and minimizing losses. And that's exactly what we're doing today. In this video, I'm breaking down a simple but 5-step process to accurately spot trend reversals, know exactly when to take action, and capitalize on every opportunity. So let's not waste any time. Let's dive right in. Step 1, identify a market with a clearly established trend. I'm going to prove to you that this is incredibly simple, so don't overthink it and definitely don't get stuck in unnecessary details. First things first, wipe your chart clean, get rid of all those indicators and make your trading chart clear and clutter-free. Now, zoom out. If a trend jumps off the screen, then guess what? You've got something to work with. So let's take a look at this chart. Is there a trend? Which direction is it moving? Now check this one. Same question, trend or no trend, up or down? And here's another one. See how clear this is? No confusion, no distractions, just pure price action telling you exactly what's happening in the market. All right, what about this one? If you have to lean in, squint your eyes and scratch your head just to figure out if there's a trend, chances are there isn't one. And here's the deal. If the trend isn't obvious, don't force it. Move on. There are thousands of stocks, Forex pairs and crypto assets out there. Keep searching until you find a market that's clearly trending and actively moving right now. This is a fundamental key that most beginner and amateur traders completely overlook, and that's exactly why they keep losing trades. But now you know better. From this moment on, always apply this first step to every single trade you take. Step 2, choose your trend reversal indicators. Alright, now we're diving deep, so pay close attention. This step is critical, and missing even a single detail could wreck your entry accuracy. And trust me, without precision, you'll never get to enjoy the sweet profits that trading has to offer. So let's bring this blank chart to life. That means adding indicators or spotting chart patterns to give us a clear edge. Now, there are tons of indicators out there, but for this tutorial, we're keeping it laser focused with just 2. The 50-period EMA, our key level for support and resistance. The CCI, Commodity Channel Index, our entry signal generator. Because this strategy relies on just two carefully tuned indicators, it's easy to follow, keeps you disciplined, and can even be automated into a trading bot. Now, let's break it down, starting with 50-period EMA. I'll walk you through the exact settings you need to ensure it adapts perfectly to the market and the time frame you're trading. Get ready, this is where things get exciting. Let's break this down. First, take a look at this. The EUSD chart on the daily time frame from June 14th, 2024 to March 8th, 2025, you can see how price consistently respects the 50-period EMA. Now, check this out, the BTC USD chart on the daily time frame. From August 7th, 2024 to March 8th, 2025, the market once again reacts to the 50-period EMA, confirming its importance. And finally, here's the GBP USD chart on the daily time frame. From April 23rd, 2024 to March 8th, 2025, we see the same pattern, price respecting the 50-period EMA time and time again. So after seeing these three solid examples, do you think the 50-period EMA is just another random setting? Absolutely not! This is one of the most widely recognized EMAs, used by banks and institutional traders alike. That's why it's a powerful foundation for incorporating moving averages into market analysis. And here's the best part. By the end of this video, I'm going to break down step by step the most precise, most advanced and easiest way to set up the moving average indicator so you can use it to its full potential. This is the ultimate method and I'm revealing it exclusively to you. But first, let's dive into this powerful strategy because this is the backbone of our entire trading approach. Master this and you'll have a rock-solid foundation for everything that follows. Let's break this down, the market's reaction to the 50-period EMA. Now let's zoom in and take a detailed look at how price reacts to the 50-period EMA, because this is the foundation of every high-accuracy entry we make. Look right here, here and here. Notice how the price bounces perfectly off the 50-period EMA. Now check this out, when the price breaks below the 50-period EMA, it stays below, confirming a bearish trend. Then once price breaks back above the 50-period EMA, it holds above it, and every time it retests the EMA, it bounces right back up, just like we see here, here and here. And once again, when price breaks below the 50-period EMA, it remains below, acting as resistance. Every time price rises back to the EMA, it rejects downward, reinforcing the trend. Now that you've seen this pattern unfold, I'm sure you can spot the behavior. The market consistently respects the 50-period EMA. We can use this reaction to pinpoint high accuracy entry signals with strong profit potential while keeping risk minimal. And here's the kicker. This is exactly the kind of entry strategy that big traders, banks and institutions rely on. So, how do we find these high accuracy entries, the ones that can consistently deliver massive profits? The answer lies in the CCI indicator, and some traders also combine it with trend lines and support resistance for even greater precision. Don't worry, I'm breaking it all down for you in this video. Alright, let me take you straight to this window. Right here, we've got the CCI indicator, but with a special setting set to 5. Now last week, I already broke down the CCI indicator and how to use it to pinpoint high accuracy entry signals. But in this video, I'm giving you a quick recap, just enough to make sure you fully understand this strategy from start to finish. CCI is one of the most powerful oscillator indicators out there. If you're serious about mastering it, there's a lot to explore. This indicator has a long-standing reputation for being incredibly effective, but for today, we're laser focused on the most important part, combining the CCI with moving averages to supercharge this strategy. As I explained in last week's video, I'm going to show you exactly how the CCI plays a crucial role in this setup. Now, while there's a lot to learn about the CCI, I'm keeping it simple. In this strategy, we're using CCI as a supporting indicator, making it significantly easier to spot high probability entry signals. First, I'll walk you through how to read the CCI to identify entry signals with high accuracy and strong profit potential. Take a look at this. On the CCI indicator, there are three critical levels, so -100, 0 and +100. These are the key levels you need to watch. If you want to spot high probability entry signals that offer solid profit potential relative to your risk, mastering these levels is absolutely essential. Let's break it all down step by step. The rules of this analysis, make sure to follow them exactly. 1. For a bullish trend, if the market is in a strong bullish trend, which you can confirm by checking that candlesticks are consistently moving above the 50-period EMA, then here's what you need to do. Wait for the market to enter an exhaustion phase. How do you know the market is exhausted? Look at the CCI indicator. If it drops below 9 as 100, the market is showing deep exhaustion. Now, here's where it gets exciting. If the CCI rebounds from below non as 100 and breaks back above +100, that's a valid buy signal. But there's a catch. If during the exhaustion phase, the CCI doesn't drop below none at 100, then we simply ignore this phase. Why? Because trades taken in these conditions usually don't yield significant returns. Now, 2, for a bearish trend. Now, if the market is clearly in a bearish trend, meaning candlesticks are staying below the 50-period EMA, the strategy works in reverse. You need to wait for the market to hit an exhaustion phase indicated by the CCI rising above +100. Now watch closely. If the CCI drops from above +100 and breaks below NANA's 100s, that's a valid sell signal. Again, if during the exhaustion phase the CCI doesn't reach above +100, we ignore it, because trades under these conditions tend to have weak returns. Why use CCI? With this strategy, you don't need to memorize hundreds of price action patterns. CCI does the heavy lifting for you. However, if you spot a price action pattern that aligns with this setup, that's even better. It boosts confidence in the trade and increases the probability of a winning entry. Is the 50-period EMA plus CCI enough? Absolutely not. We're not here to chase every signal. We're only interested in high accuracy signals with maximum returns. The key, understanding how price interacts with the 50-period EMA, just as I explained earlier. That's the real secret to filtering out noise and focusing on the trades that matter. Let's dive deeper. CCI entry signals in this strategy. The effectiveness of a CCI entry signal in this strategy depends entirely on where price is positioned when the signal forms. As I explained earlier, if price breaks below the 50-period EMA, it tends to stay below it, indicating strong bearish momentum. On the flip side, if price breaks above the 50-period EMA, it usually remains above it, signaling a bullish trend. Why does this matter for our trading strategy? This behavior is key to identifying markets that aren't just trending, but trending with extreme strength. And how do we confirm this? By observing how price reacts when it reaches the 50-period EMA. Let me simplify it. In a bullish trend, when momentum weakens, price starts dropping. If it falls all the way to the 50-period EMA and then breaks below it, the trend has shifted into a bearish market. In a bearish trend, when momentum weakens, price starts rising. If it climbs up to the 50-period EMA and then breaks above it, the market has transitioned into a bullish trend. But here's the game changer. Sometimes, instead of breaking through the 50-period EMA, price bounces off it. And when that happens, it's a clear sign of a powerful trend because the market is actively rejecting a reversal. This is the exact opposite of a weakening trend and a huge clue for high probability trades. And this is where we strike. In this strategy, we wait for price to bounce off the 50-period EMA and look for a valid CCI entry signal at that moment. This creates a powerful confluence, making it one of the most profitable entry spots in trading. Every trader should know this because this is where massive opportunities are hidden. Now let's see this strategy in action. Everything we've covered so far, now it's time to put it to the test in a real market scenario. Take a look at this chart. Price has successfully broken above the 50-period EMA. That tells us one thing. The market is in a confirmed bullish trend. This is our first key requirement, a clear, established uptrend. Now on to rule number 2. The market must go through a deep exhaustion phase. And how do we spot that? The CCI indicator drops below -100. If you look closely, once CCI enters that oversold territory and price retraces down near the 50-period EMA, this is our first major clue. A high probability buy signal could be forming. Now for the third step, confirmation. If price bounces back up and CCI breaks above +100, we have our golden ticket. A high accuracy buy signal with massive profit potential. Executing the trade, here's what you do. As soon as we get this signal, we enter a buy trade on the next candle's open. But where do we place our stop loss? You have two solid options. One, stop loss below the 50-period EMA. Why? Because in a bullish market, price naturally moves away from the EMA. This stop loss is tight and efficient, keeping risk low while maximizing the risk to reward ratio, meaning small risk, big potential profit. 2. Stop loss below the nearest swing low. This is a classic approach used by price action traders. A wider stop gives price more room to move, reducing the chance of getting stopped out too early. The trade-off? Lower risk to reward ratio compared to the first option. And then, boom! Just like that, price skyrockets, locking in massive profits. This is the kind of trade every trader dreams of. Sell trade. Here's how you catch massive profits. Now, let's flip the script and talk about how to execute a sell trade with precision. Take a look at this chart. Price has broken below the 50-period EMA. That tells us one thing, the market is officially in a bearish trend. This is our first major rule, a clearly established downtrend. Next, rule number 2, we need to see the market enter an exhaustion phase. How do we confirm that? The CCI indicator must spike above +100. If we zoom in, we can see that once CCI reaches this overbought zone and price moves up near the 50-period EMA, this is our first sign that a high probability sell signal is forming. Now for the most critical step, the entry. If price rejects the EMA and starts dropping while CCI plunges back below -100, we have a textbook high accuracy sell signal. This is exactly the type of setup we're looking for in this strategy. And what do? We execute a sell trade at the open of the next candle. Play it smart. In this setup, the nearest swing high aligns with the 50-period EMA. That's a key resistance zone, so we place our stop loss just above both of them for maximum protection. And just like that, boom, price plunges hard and fast, locking in massive profits. This strategy is incredibly powerful, but there's one golden rule. You must stay disciplined and follow every step exactly. As I mentioned at the beginning of this video, today we're diving deep step by step into the most precise, most advanced, and most effective way to set up the moving average indicator. If you want to master moving averages and use them flawlessly in any market and any time frame, this is the ultimate guide you need. Let's start with one of the most widely used EMAs in institutional trading, the 50-period EMA. It's a go-to for banks and hedge funds, but here's the catch. It doesn't work the same way in every market and every time frame, and understanding this is the key to mastering technical analysis. Take a look at this chart. At first glance, the 50-period EMA looks like a solid level. Price keeps reacting whenever it approaches the line. But let's zoom in. What if we swap it out for a 150-period EMA? Now we see that price is responding even more accurately to the 150-period EMA instead of the 50. Now, let's analyze this next chart. Here, price seems to respect the 50-period EMA, making it a decent guide for trend movement. But wait, what if we fine-tune it? Instead of a 50-period, let's try an 80-period EMA. Suddenly, the price movements align even better with the EMA, making it a far more accurate tool for this particular setup. Next up, check out this chart. We're testing multiple EMAs, 50, 100, 200, 80, 20 and 30-period EMAs. And after analysing them all, guess what? The 30-period EMA turned out to be the most reliable for capturing price movements in this scenario, and that is how you use moving averages the right way. No more guessing, no more confusion. Instead of blindly applying a single EMA to every market, test how price reacts to different periods. Once you find the EMA that consistently aligns with price action, stick with it for that market and time frame. Now go test this on your own charts and see how much more accurate your trades become. Alright, to complete this tutorial, I'm about to break down some of the most powerful yet easy to master moving average strategies. Strategies that are not just effective but can actually help you consistently make profits. 1. Combining EMA and trend lines. Now, let's talk about one of the simplest yet most effective ways to trade using moving averages. This is a game changer, a method that allows you to spot high probability trade setups with precision. So here's the deal. I'm going to walk you through step by step exactly how to combine the EMA and trend lines for trading Forex, stocks, commodities, literally any financial market. And more importantly, I'll show you how to use this strategy to maximize your profits consistently. You'll learn exactly when to enter high probability trades using the EMA indicator, reinforced by a perfectly timed trendline signal. And I'm not just explaining the theory, I'm diving straight into real market examples, so you can see this strategy in action. The goal? To fully understand this powerful trading technique and use it to your advantage. So let's jump in. At first glance, this strategy might seem simple, but don't be fooled. This is an advanced trading strategy. That's why you need to pay close attention and follow each step carefully. Even the smallest details can make a huge difference in how this strategy plays out. All right, let's break it down. Step 1. Apply the EMA indicator to your chart and set the EMA period exactly as I showed you earlier. In this example, we're using the 60 period EMA. Step 2. Draw the relevant trend line to confirm that a clear market trend is in place. Step 3. Watch for a breakout. We're looking for price action to break both the trend line and the 60 period EMA. Now, once you have the trend line and EMA set up, here's exactly what you need to do. First, spot an early warning signal, a breakout of the trend line. In this chart, the price breaks the trend line from below to above, signaling that the bearish trend might be coming to an end. But the confirmation happens only if the price also breaks above the 60 period EMA. That's your cue to get ready because the trend could soon reverse into a bullish move. Second, price breaks above the 60 period EMA. Sometimes price crosses the EMA before breaking the trend line, and other times it happens after. Either way, that's totally fine. What matters is that both levels get broken. Look at the left side of the chart here. Price broke the 60 period EMA, but failed to break the trend line. The market held its position instead of reversing. So the moment price successfully breaks above both 60 period EMA and the trend line, traders can enter a buy position on the next candle's opening. There are 3 ideal stop loss levels in this strategy. 1 below the EMA line, 2 at the nearest swing low, 3 at the starting point of the bullish trend. In this example, placing a stop loss below the EMA isn't ideal. It's too close to our entry point, and placing it all the way back at the start of the bullish trend would be too far. So the best option here, right below the nearest swing low, and then boom, the market explodes into a bullish trend, locking in massive profits. Now, since this is confirmed bullish trend, you can take advantage of multiple buy entry points using additional techniques like combining CCI and EMA analysis to pinpoint more precise setups. Let's break down exactly how to execute the perfect sell entry with this strategy. Step 1. Set up your EMA. First things first, apply the EMA indicator to your chart and set the period exactly as I showed you before. In this setup, we're using a 60 period EMA. Step 2, draw the trend line. Next, identify the market trend by drawing a clear and relevant trend line. This helps us confirm the price direction before we enter a trade. Step 3, watch for the breakout. Now, this is where things get exciting. We're looking for a price breakout below both the trend line and the 60 period EMA. This is our key signal to enter a sell trade. Once you've got your EMA and trend line in place, here's how you execute the sell entry. Step 1, identify the breakout. Look at the chart. Notice how the price breaks below both the trend line and the 60 period EMA almost simultaneously. That's a strong confirmation that the bullish trend is ending and a bearish trend is taking over. Step 2. Understand the sequence. As I've mentioned before, sometimes price crosses the EMA first and other times it breaks the trend line first. In this case, both breaks happen almost at the same time with the same candlestick. Which one comes first? It doesn't matter. The key is that both confirm the new trend direction. Step 3. Execute the sell trade. Once the price successfully breaks below both the 60-period EMA and the trend line, it's time to place a sell order at the next candle's opening. Managing risk is crucial, so let's set our stop loss correctly. This strategy gives us 3 options for stop loss placement, 1 above the EMA line, 2 at the nearest swing high, 3 at the starting point of the bearish trend. For this specific trade setup, the best stop loss placement is right above the nearest swing high, which is right here, and then boom! The market drops sharply, confirming the bearish trend and delivering huge profits. That's everything you need to know. Simple, right? But here's the real secret to making this work. Stay consistent. I said it before and I'll say it again. Discipline is everything. One of the biggest mistakes beginner and amateur traders make? They ignore the rules. If you take a few losses, don't start tweaking your strategy. Don't clutter your chart with extra indicators that only confuse your analysis, and definitely don't mess with your indicator settings. Stick to the system, because this strategy is a powerhouse when used correctly. This is all you need. No gimmicks, no distractions, just pure high accuracy trading. And as always, if you learned something valuable today, make sure you subscribe, hit that notification bell, and drop a like to show your support. I'll see you in the next one.